All right, welcome to How to Become Your Own Banker. This is the Money Multiplier Infinite Banking full training so you can learn how to become the bank. So I guess the question at that point becomes, why would you want to be a bank? So let me ask everyone that's on here right now, especially if you're new, why would you want to be a bank? To me, yeah, absolutely interesting. We're going to talk about that here tonight, how banks work, how they take your money, they immediately start lending it out, making what's called a spread on it. James says, I don't like paying fees and interest. Dexter says control. I love the control part, especially. So for me, why becoming your own bank makes so much sense is because it's what we do. And if you did own your own bank, where would you go deposit all of your money? Well, you do so in your own bank. And so that's what I'm going to show you how to do tonight, is exactly how to establish an account that'll mimic essentially what a bank does and allow you to become your own bank, control your money, and take advantage of everything that banks take advantage of as well. And we'll talk a little bit about that as we go. So, the best way I can really explain this to you is, if you owned a bank and you had your own ATM, and you knew every time you went to that ATM and you deposited $20,000 into your own bank, and the next day you could immediately pull back out $50,000, $60,000, $70,000. Every time you put 20,000 in, you're pulling out 50, 60, $70,000 the next day. How many of you would love to have an ATM or a bank like that? And if you did own that ATM, how many of you would want to go to it time and time and time again? Would you like that right there? Absolutely, right? So that's exactly what I'm going to show you tonight, is exactly how to start your own bank today. So you're able to have your own printing ATM later on that functions just like the way that I'm saying. So hopefully that gets some of you excited. So that's what we're going to get into tonight. So like I said, this is the Money Multiplier presentation, what we call mapping out the millionaire mystery. My name is Stephen Nagy. And my contact information is on the screen right there, but I'll share that with you guys a little bit later on. So as we start talking about banking, we're going to talk about money. We're going to talk about opportunity. We're going to talk about the markets. We're going to talk about why all this stuff is so important. And today has been a rather historical day. I mean, the stock market fell more today. I think it was the single largest drop since June of 2020. Right when everybody started realizing that what COVID was doing and shutting down the country and nobody could go to work and everything crashed. And then, of course, we all know the Fed stepped in and pumped trillions and trillions and trillions of dollars into the markets and bought up trillions and trillions and trillions of dollars of assets and whatnot on their books. And it drove in spending and it drove inflation through the roof. Highest inflation of my lifetime as the result of all that. And it just seems to be right now snowballing and getting worse and worse. So we're not going to talk in depth about money and opportunity tonight. That's what our other webinars are for. So what I'll do is in a little bit, I'll share a link with you guys so you can go on and request, and I'll email you a schedule. I do 6 live stream webinars every single week. And those are where we dig into the markets. We talk about opportunity. We talk about money. But tonight is specifically focused on the infinite banking concept and becoming your own banker. So join me for the other webinars throughout the week to talk more in depth about money and opportunity. So a couple people I wanted to introduce you to, a couple of my mentors when it comes to the infinite banking concept. So this guy right here, Brent Kessler, and throughout tonight, I'm going to be asking you all to do some homework. I'm going to give you some work to do for after this thing. So one of the things I want you to do, go check out themoneymultiplier.com. Brent Kessler is my business partner, my broker, the founder of Money Multiplier, an incredible human being. He's taught me a lot about banking as well as business, to tell you the truth. And then Chris Noggle, if you're here right now, you probably know Chris. Chris is my friend now. We actually just had on Facebook today, our 4-year Facebook friend anniversary. So we've been friends now for 4 years. I've been doing business together for about 3 years now. And we do everything, money school, private money club, everything that we do with our training and coaching programs. And Chris is a wonderful guy. All of you guys probably know him that are on here. And when I first met Chris, you see that quote on the screen right there. It's never about your actual resources. It's about how resourceful you can be. And think about that for a second. Like, if I was able to ask each one of you that are on right now individually what your current financial situation is like, every one of you would be different. what your goals are like. Every one of you would have different goals, what your dreams are for the future. But the beautiful thing about what we do, whether it's banking, whether it's real estate, whether it's taking control of your money, no matter if you're starting right now $500,000 in debt, starting at ground zero, or starting with some decent money, millions maybe in the bank already, you have a money problem. But your money problem is different from that person's money problem and that person's money problem. See, everybody has a money problem, but what we need to do is figure out that money problem and how it relates to you. And the beautiful thing about what we do and what we teach, especially here right now tonight, is this strategy and this concept can help every single one of you, whether you're in massive debt or whether you have plenty of money put around or whether you're somewhere in between. This will work for you. So we're going to talk a little bit about that as we get into this. And, you know, one of the best ways that I can explain what is, what goes on in this country is to look at success and look at retirement. So if I was to take everybody on this call right now, let's say there's 100 people on here right now, and I was to say, pick 5 of you, statistically speaking, only 5 out of 100 of you on this call right now are going to be able to retire financially secure. The Social Security Administration tells us 5 out of 100 people will be financially secure at retirement age, meaning 95% of people in what I believe is the richest country the world has ever known, with more opportunity than we've ever seen in history. Would you agree with me on that? I mean, the opportunity we have on a daily basis in this country is mind-blowing. We just need to take advantage of it. And so the fact that 95% of people doing what they've always been told to do in life are not able to enjoy retirement and be financially secure is a massive failure, in my opinion. And it's something that needs to be done. Something needs to change. And that's why I'm here right now, primarily, because what I found is if I can change your mindset a little bit and show you how to change one thing, besides your mindset, how to change one thing with your money is where your money goes first. You're not taking on any more risk. You're not working any longer. You're not working any harder. We're just going to change where your money goes first. And by making that one change, it'll change everything for you financially. And you'll see that by the end of this presentation right now. But why aren't more people successful in this country with the most opportunity in the history of the world, in my opinion? Well, it really boils down to these 6 reasons that you see on the screen right here. So these top 3 reasons: taxes, inflation, and volatility. This is all stuff that we can control on an everyday basis when it comes to our money. So who loves paying taxes? Anybody here? I know I sure don't, but it seems like we pay more and more taxes every year. It seems like we're getting taxed for more and more things. Property taxes are always going up. It seems like our income taxes are going to be going up. So everything always seems like it's going up. So how do we protect ourselves? These top 3 things are also what we call in money school the 3 wealth killers, because they will destroy your wealth. So how do we start taking advantage of laws? How do we start taking advantage of strategies that allow us to start reducing our taxable amounts that we're paying? The more you make doesn't necessarily mean the more you're going to pay in taxes. And if you're okay with that, then pay close attention, because we're going to get into that. We're going to put our money into things like tax-free vehicles where we get tax-free growth. Inflation, I mentioned it before, it's at an all-time high. I think everybody right now knows about inflation. It's funny because I used to actually have to teach what inflation is, but because it's been running so hot for the last year, it's been all over the news. Everyone already knows what inflation is now. They're being affected by it. And all I got to tell you is, what's your grocery bill look like? Go to the grocery store. That's inflation. Volatility. That's what we saw today in the markets, a 1,300 point drop, 4% drop in the Dow. I think it was like over 5% in the S&P, 4.5% in the NASDAQ. Somewhere around there. That's wild numbers. That's a volatile market. And one of the major causes of today's decline was the inflation report. And so the Fed is going to have to continue to tampen this stuff down. It's going to continue to do quantitative tightening. It's going to continue to jack up interest rates, and it's just going to continue with the volatility. So, it's all fine and dandy if you're young. I mean, if we look at things like the drawdown effect and average versus actual returns, and, volatility is not good for your money, but let's just pretend you're young and you have time for it to come back. You have time to kind of ride this wave. Well, why would you do that? You never want to time the markets, but if we know that this stuff's happening right now, why not be smart about what we're doing with our money, where we're investing our money? There's no reason to ride these volatile waves that we're seeing right now. So we need to start eliminating volatility. And what I'm going to show you here right now is how we can put our money into vehicles where we're going to combat inflation by continuing to keep our money moving. We're going to eliminate taxes by putting our money in tax-free vehicles, and we're going to eliminate volatility by putting our money into guaranteed vehicles where we can control it as well. And then the bottom three reasons here why more people aren't successful, that's just mindset. That's up to you. And I'll give you an example. Following the status quo, a great example of that is a 401k. I mean, what do you really know about a 401k? Put money in, you do it because everybody else does it. You know, it sounds like a good deal. You put your money in, it grows tax deferred, and then you take it out, you pay taxes on it then. Well, why would I want to pay my taxes in 30 years from now? What do taxes always seem to be doing? So what are we doing? We're giving up control of our money. I put my money in a 401k, and 10 years from now, I want to pull it out to go do something else with it. They're going to penalize me. Not only am I going to pay taxes on everything, they're going to pay an extra 10% penalty just for taking it out before retirement age. And then we're giving up control, because what are our options to invest in a 401k? The stock market, the stock market, or the stock market. Tell me, if you have a 401k on this call right now, what percentage is your 401k down this year? How much money have you lost in your 401k this year? Because every single client call that I do throughout the week, they're telling me they're losing a ton of money, tens of thousands of dollars, if not hundreds of thousands in their 401k right now. So why are we doing this? Because it's the way it's always been done, because it's what you've been told to do your whole life. We got to start changing that. You know, fear, maybe we're scared to do something different. You know how you overcome fear? Education, support, help, having a team surround you, having the right mindset. That's what this is all about right now. We provide the support, we provide the education, we provide the training. We give you that hand. We teach you step by step exactly what to do to change that one thing for you and your family. And then life, stuff happens in life. I get it. COVID hits, we lose all the businesses are shut down. Your restaurant's forcibly closed. You lose your job. Things happen, divorces, disasters, deaths. Things happen in life, and they can be financially devastating. But guess what? They are financially devastating for a lot of people, but they don't need to be. You see, we can plan for some of this stuff happening. Nobody can predict COVID, but we can put ourselves in a position where if we lose our job, if our business is shut down, we have other streams of income coming in to hold us above water till we can get our primary source of income going again. So there's no reason why we have to let this stuff stop us. Deaths, we can put ourselves in positions where if somebody dies important in their life, we're covered. Other disasters, where we can do things to prepare for this stuff. So we just need to be smart. We need to learn something new. And that's what I'm teaching you right now today. You know who says this best? A guy named Will Rogers. He says the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. Think about that for a second. Anybody that's in real estate on here? Anybody in real estate on here? Anybody doing real estate investing? Do you remember when you first got into real estate investing and you went and told your friends or your family, hey, I'm a real estate investor now? What did they say to you? They probably laughed at you. What makes you think you could do that? What makes you think you can go out there and flip houses like you see on TV? What makes you think you got the kind of money to do that? Well, guess what? It's not about your resources, your actual resources. It's about how resourceful you can be. I could tell you 10 different strategies right now. If I pull out my whiteboard, 10 different ways to fund real estate deals with none of your own money. It's not hard. It's just stuff you maybe never learned before, stuff that nobody else is teaching you. So just because you've been told something to do something your entire life doesn't mean it's right. Just because you've been told to do something one way your entire life doesn't mean there's not a better way. And that's what financial education is all about. That's what mindset training is all about. That's what tonight's training is all about. And I'll give you a great example of that. Hop on YouTube after this and type in the backwards bicycle. Go on YouTube and type in the backwards bicycle. It's a fascinating video. It's like 8 or 10 minutes long. And this young guy, what he did is he took a bicycle and he reversed the way the handlebars work. So you hop on a bicycle and when you turn one way, now it goes the other. Different than what you've rode a bicycle your entire life. And a bicycle, that's one of those things you never forget how to ride. Why? Because your mind remembers it. So when we go to change what our mind has remembered our entire lives, it's very difficult to do. So we repetitively have to beat it into our heads almost. We have to keep it in front of us. We have to surround ourselves with positive people, people that think like we do, people that have similar goals that we have. but it's a fascinating video. Go check it out, The Backwards Bicycle. And then continue to read, continue to study, continue to hop on our weekly webinars, go on YouTube, educate yourself, read books, listen to audiobooks. These are a few really good ones to start with. I got this one right here, Second Chance by Robert Kiyosaki. Need Robert Kiyosaki fans on right now? I had the opportunity to train and speak with Robert Kiyosaki and work on his team back when I was just getting started in real estate investing years ago. Unbelievable guy. Rich Dad, Poor Dad series literally changed my life, changed my entire way of thinking, which ended up changing my entire attitude when it came to money, when it came to investing, when it came to business, and what I knew before versus what I learned reading Kiyosaki. Love him. He wrote his books with a lady called Sharon Lechter. Just a few months ago, I had the opportunity to have lunch with Sharon and sit and hang out with her for 2 days and chat with her. Amazing person, just amazing. So check that book out. Robert writes all about the concept I'm teaching you right now, infinite banking, in that book, Second Chance. Tony Robbins, great for mindset. Tony writes all about infinite banking in his, I think it's the 3rd or 4th chapter of Money Master the Game, another excellent book. Got a copy of that right there. Becoming Your Own Banker. That's basically like the Bible, so to say, of what we do with the infinite banking concept. See, R. Nelson Nash is credited with bringing what I'm teaching you right now to the limelight in modern day. See, what I'm teaching right now is nothing new. It's been used for over 200 years by some of the wealthiest families in this country. And what we're doing is we're just mimicking that. We're doing it in a way where anybody, no matter who you are right now, you don't have to be a multimillionaire anymore to take advantage of these strategies. Anybody can do this. So that's it. Perfect starting point if you want to read a new book when it comes to infinite banking, Becoming Your Own Banker by R. Nelson Nash, and then get into Mapping Out the Millionaire Mystery. That's an updated version, more practical version of Becoming Your Own Banker for today. And that Brent, my mentors, Brent and Chris Noggle wrote. So check that one out. And the Private Money Guide, all about moving money and how banking works with real estate investing and private money lending. And actually what I want to do as a bonus for everybody that's on here right now, those bottom 2 books, I'm going to give you a free digital copy of both of those books right now. Do you guys want those? Because I want you to get started as soon as this webinar is over, even before we even talk on the phone. I want you to start continuing your education. I want you to continue to learn about this stuff. So I'm going to send you digital copies free of charge of both those books. Are you guys okay with those? With that? So all you got to do is you got to go to that website on the screen right there. I'm going to put it in the chat box also. So go there right now, request the books, and they'll immediately be emailed to you. And that way you guys can start reading those right away. Fair enough? Do you like that? All right, cool. All right. So again, my name's Stephen Nagy. I live down here in South Florida in the Jupiter area. This is my family, Courtney and Bryce. I've been doing this financial education. I've been in the real estate and investing world for 15 years. I was a personal financial advisor, fully licensed, Series 766. Licenses. I had a Florida 215 variable annuity license. I was an advisor for 2 years with Ameriprise Financial. I learned about real estate investing and entrepreneurship, got into that, and never looked back. I let my licenses go about a year or 2 later, and that was my point of no return. That's when I said I worked harder than I probably worked for anything in my life to get those licenses. And just a few short years later, my career path and my life path changed, and I let them go to pursue something new, a dream that I didn't even know I had before, but I could not let go. And that was 15 years ago, and I've been doing it ever since. So I've been investing in real estate. I've been starting businesses, selling businesses, building teams, building businesses, and more importantly, training, speaking, coaching clients, students, people just like you ever since. I love doing it. I just flew. I was up in Cleveland, Ohio, speaking to a wonderful RIA group up there. Thursday, woke up Friday morning, flew into Dallas, Texas, spoke in front of a group of about 150 real estate investors Friday afternoon, teaching them this concept right now, Becoming Your Own Banker. I'm flying Thursday out to Lafayette, Louisiana to talk to a group of real estate investors. So I absolutely love what I do, teaching other investors and other business owners and really anybody that just wants to change their financial future, how to become their own bank and make that one change in their financial lives. So with that said, let's start digging into. So let me ask this question real fast. Can you make money earning 4% while paying 6%? What do you think? Yes or no? Put it in the chat box. And let me see these questions while you guys are putting that in there. Can you make money earning 4% while paying 6%? What do you think? Okay, just reading through the chat box while I'm waiting on that. William said, because nobody cares about your money more than you do. That was when I asked them why become your own bank. And I love it, William. You're 100% correct. I can tell you as a financial advisor, I had a fiduciary responsibility for my clients. Did I truly care about their money per se? I mean, I cared about my clients 100%, but did I care about their money as much as I cared about my own money? Probably not, a little different mindset these days, but back then in my mid-20s, I mean, different world, Dexter said, wouldn't miss a day and I'll kiss the screen each time. I love it. Let's see. Yeah, Robert Kiyosaki's awesome test, right? Love Cash Flow Quadrant. Excellent book. Me too. So let me show you how this works. The answer to this question is yes, you can. And the reason why it happens is, let me use a car loan as an example, and let me use a bank account as an example. So if you had a car loan for $25,000 and it's 6% that you're going to pay on that car loan, and let's say it's for 5 years, 60 months. If you do the math on this, it's $483 a month. So every single month that you have this car loan, you're paying the balance down, essentially. So the $25,000, the first month is $25,000. And then each month that you pay on that car loan, it lowers by $483.32. The 6% for 5 years that you're paying, that 6% annual is on the depreciating balance. So each year you're paying 6% on a less and less and less and less and less and less and less amount. Over here, $25,000 at 4% over the same 5 months. But what's happening over here? See, over here, that $25,000 is compounding every single year. So the first year you have $25,000, then you have $25,000 times 4%. Then let's say that's 26,000. Then you have 26,000 times 4%. Let's say that's 27.5. Now you got 27.5 times 4%. Maybe that's 29. Now you got 29 times 4%. Now that's 30,525, right? See it right there. So right here, 25,000 at 6%, we end up with 28,999. 25,000 at 4%, same amount of time, we end up with $30,525. So we actually are able to make $1,500 by paying 6% and earning 4%. And that right there is important to understand, because a lot of what we do with this new banking policy, with this new banking account that we're going to create for ourselves, is we're going to take advantage of similar strategies with uninterrupted compounding interest while we simultaneously use this money. So I just wanted to show you the power of compounding interest, and you can make money earning a smaller amount while paying a higher amount if it's set up properly. Fair enough? You guys okay with that? Galaxy, I'm not sure what your name is, maybe Carmen, since that's in the email, says, I don't think I need more info. Can you email me where I go to invest? Yeah, this is not an investment though, Carmen. So I don't have anything to sell you. I don't have anything to have you invest in right now. This is to become your own bank. So if you would like to schedule a call with me to have your bank set up, I can do that free of charge. You'll never pay me a dime. So I can absolutely do that. So what you want to do is just schedule a call with me. So if you go on that link that I just posted, there'll be a call calendar on there and you could schedule a call. Or if you'd like to text me and set up a call sooner, you can do that as well. That's my email or my cell phone right there. Just send me a text message and we'll set up a call later this week, beginning of next week, this weekend, and I'll help you guys get started. So let's see. Rajit said, come again on those numbers on previous slide. Just want to understand again. Yeah, so real fast before I get into the method, just one more time. The 25,000 on the left side is a depreciating balance. So every time you make that $483 payment, the $25,000 balance is reduced. Okay. Think about your car loan. If you have a car loan, if you want to pay your car loan off, you have to call them and get the balance, because every single payment you make reduces the balance of that loan. And the interest rate that is charged on a car note is charged on whatever the balance is at the time. So it reduces the balance. So the amount you're paying in interest is less and less and less and less as time goes on. Over here, this is compounding interest. Let's say that 25,000 sitting in a savings account that pays you 4%. Well, if the 25,000 sat in that savings account for 5 years, compounding at 4%, that's what the money would grow to be. So if you have a compounding calculator, go put in $25,000 at 4% over 60 months, you'll get this number. go to like CarMax.com or Ally Financial and get a car note calculator, put in a $25,000 car loan over 5 years at 6%. And this is what you'll see happens. So it's just math. That's all. So what is this method? Well, it consists of 3 parts. It consists of the machine, which is the vehicle we're going to use, the account that we're going to create, the bank, the marathon. This is not get rich quick. It's get rich, but it's not going to happen overnight. It's going to take a little time. It's going to take a few years. We could start taking advantage of it immediately right now, today, within 30 days, we can take full advantage of it, but it's going to take a few years to really get kicking in for you. But if we do these 2 things properly and you want to become a millionaire, how about a multimillionaire? That's part 3 right there. All right, so let's dig into this. Ranjit is asking what's the correlation between them. So the reason I'm showing you this will make sense in just a second, because we're going to put our money into a vehicle that takes advantage of uninterrupted compounding interest. And then we're simultaneously going to pull that money out and pay simple interest on the money. So you're going to see the huge difference of compounding versus simple interest, simple depreciating interest. So it'll come together in a minute for you, Ranjit. All right, so what is the machine? The machine is nothing more than a dividend-paying whole life insurance policy from a mutually owned insurance company. That's it. So that is how we're going to create our own bank. So this is what me and my team do every single day. And let me clarify this. This is not a whole life insurance policy that you get from your broker, you get from your friend, you get from your brother-in-law, you go on policygenius.com, you call the insurance company direct. This is not that. 99.5% of insurance agents have no idea how to design a policy properly, a whole life policy properly for banking purposes like we do. So this is what myself and my team at the Money Multiplier do every single day. We design these policies and customize them for you. We especially design them and engineer them for banking principles, for banking purposes. This is how you become your own bank. All right. So let me make that very clear. We do this for you and we're going to design it properly for you. We've been doing it for over a decade, thousands and thousands of policies a year. All right. We use a mutually owned insurance company that pays dividends because that's the way it works. And the reason why we use a whole life policy in the first place is because there's no other vehicle out there that allows us to do what we do with this thing. There's not another machine, not another vehicle, not another account that allows us to put money in something, get tax-free, guaranteed, uninterrupted growth while simultaneously pulling out and using it. Nobody. In fact, let me show you how other people are using this thing. So if we look at more homework, bank-owned life insurance, type in BOLI, go Google BOLI later, B-O-L-I, bank-owned life insurance. And so what's going to happen is, I mentioned before, why would you want to be the bank? And I had some great answers on there. Well, for me, the reason I want to become my own bank is because I want to mimic what banks do. Let me ask this question. Do banks know how to make money? Banks know how to make a lot of money. Banks are very good at making money. Banks are in the business of money. And so if banks know how to make money, then why would I not want to mimic what the banks do? So when it comes to banks making money, do you know where banks put over 90% of their money that they make, their M1 money supply? Do you know where over 90% of it goes? It goes to 2 different places. Number one, it goes to real estate. So think about real estate and banks. Skyscrapers in the largest cities across the US. A lot of them often have bank names on top. Go to any high-end areas around the world, around the country. Worth Avenue, Beverly Hills, all these different places. You see banks and financial institutions on these buildings and the highest priced real estate in the world. Banks buy real estate. So I buy real estate. It's why we have so many real estate investors, why I believe in it so much, why we teach it through Money School. But what else do banks do with their money? So they put it in 2 places. One is real estate, but where they put most of their money, even more than real estate, they put it in whole life insurance. Banks are the largest purchasers of whole life insurance in the country. And I'll show you why they do it in just a second. So if banks are doing it, it's okay if we do too. So who else is putting their money in whole life? Well, this has become a very popular strategy for executives. And Jim Harbaugh is a great example. So it's football season right now. Football's back, you football fans. So Jim Harbaugh is the head football coach of the Michigan Wolverines. But this was back in 2016. Jim Harbaugh became one of the top paid college football coaches in the country. And in his contract, it included creative deferred compensation alternatives involving cash value life insurance. This is being used all the time right now. Joe Biden, president of the United States of America, when he was running for president, this article came out and it says he also, in addition, holds 6 life insurance policies with Mass Mutual. Mass Mutual is one of the mutually owned insurance companies that we do business with. See, these life insurance policies, why the rich, why the famous, why the politicians love them is because they're private. They're protected. The money that's in there, the money that they're taking out to use, it doesn't have to be reported anywhere. It's very private. It's very protected. Walt Disney of Disneyland used cash value life insurance to collaterally borrow against when traditional means of financing failed, so he could build Disneyland. And I have tons of examples of this. Doris Christopher used it to start Bamford Chef. Ray Kroc used it to start McDonald's. People like the families like the JPs, the Morgans, the Vanderbilts, the Chases, the Rockefellers, they've been using it for over 100 years to build and create wealth for them and their families, to create family banking systems, to do exactly what I'm teaching you to do right now. So to be able to start understanding this, we do need to understand a little bit more about how banks work. So let me just show you a quick example of how banks work. So when you take money and you go deposit it at the bank, let's just say that you have a savings account that pays you 4%. Now, I know that we're not seeing savings accounts at 4% right now, although if rates go high enough, we might start seeing that again. But it doesn't matter, because no matter where rates are, banks are always going to make what's called a spread. And this is going to show you exactly how banks make money, because when you take your money to the bank and you stick it at the bank, they don't just like hold on to that money and wait for you to come get it back. They immediately take that money, and what do they do with it? They get it moving. They start lending it out. So they do things like they lend it to somebody on a home mortgage, where that home owner takes the money, they buy the house, they give it to the sellers, and the sellers take it and they put it right back in the bank. But the bank charged that homeowner, let's say 7% for that mortgage. Banks do things like take money and they lend it out on vehicles, car notes. They do things like home remodel loans. They do things like debt consolidation loans. And every time that they lend this money out, all they're doing is they're making a spread. So if we do the math, if they're paying you 4%, they're making 7%, they're making a 3% spread on your money. Then they take that money, they lend it out at 8%. They're paying you 4%, 4% spread on the money, 5% on that loan. They make 8% spread on that loan. So at the end of the day, the bank just made 20% on your money while paying you 4%. However, think about this for just a second. Did the bank really make 20% off of your money? No. The bank made 500% on your money. They're paying you 4%. They're making 20%. That's 5 times more. That's 500% more that they're making off of your money. Why do you think banks know how to make money? Why do you think banks are able to buy all this real estate, buy all this whole life insurance, be so successful? Because they're making tons of money off of your hard work. Why are you putting all of your money at their bank? Why aren't you putting that money at your bank and making this returns? That's exactly what we're going to do. That's it. We're going to change where our money goes first. So let me give you an example. You don't have to take my word for this. Go to BauerFinancial.com, BauerFinancial.com. This is an organization. All they do is they research banks, tell you what banks are doing, how they make money, all that stuff. BauerFinancial.com tells us banks make between 400 and 1,300% off money that you leave there. So let's stop doing that. So let me show you how we can start doing this, all right? So to understand how we're going to start redirecting our money, let's understand how we spend money first and where all of our money is going. So on average in this country, if we take a dollar bill, for every single dollar that you make, on average, 20 cents of that dollar goes towards an automobile. On average, 30 cents of that dollar goes towards housing. 40 cents of that dollar goes to everything else. So other bills, food, taxes, insurance, trips, kids, everything. There's a lot in life. So 40 cents of every dollar that we make goes to everything else. So what's that leave us with at the end of the day? 10 cents. And a lot of Americans, especially right now with inflation through the roof and everything that's going on with food and everything, a lot of people don't even have that 10 cents anymore that they're saving. That's been dwindled away. Why? Because we don't pay ourselves first. We're giving everybody else all of our money, and then whatever's left over, we might try and keep for ourselves. That seems backwards. Are you important? Absolutely, right? So why wouldn't you want to take care of yourself first and then everybody else? So I'm going to show you how we do this in just a second. But what if, play with me for a second, what if we were to pay ourselves first and then we pay everybody else? So let me show you what that would look like. What if we start with the 10 cents into our savings and then we start paying everybody else? So let's take an automobile for an example. On average, 5 cents of every 20 cents that goes towards an automobile goes towards interest. 5 out of every 20 cents goes towards interest. So what if instead of paying that 5 cents of interest to Ally Financial or BMW or whoever, what if we pay that interest to our bank? You okay with that? So let's do that. So what did we just do right there? By making that one change, paying ourselves first into our bank and then paying ourselves the interest into our own bank, we just increased our annual savings by 50%. Think about it. We were saving 10 cents before, or we just saved an additional 5 cents now. That's 15 cents. That's 50% increase in our annual savings by doing that one thing. Is that hard? Are you okay with that? Okay. And then if we could do that with our automobile, what else can we do that with? How about your houses? How about your properties? Did you know that on average in this country, a homeowner either moves or refinances on average every 7 years? It's one of the reasons there's due on sale clauses in mortgages. It's one of the reasons, why people why banks are constantly doing teaser rates and things like that. Because did you know on average on a 30-year fixed mortgage, over 90% of all interest paid on a 30-year fixed mortgage is paid in the first 7 years? So if banks are getting over 90% of their interest within the first 7 years, do you think it's coincidence that people are moving and refinancing on average every 7 years? It's not a coincidence. Banks know what they're doing with this stuff and they make it happen. They're getting all that interest. So instead of giving all that interest to other people, what if we brought it back into our bank? Let's do that. Let's take that 25 cents back. And then while we're at it, on average, 5 cents of every 40 cents for everything else goes towards interest. So while we're at it, let's get that 5 cents back as well. So by doing nothing different except where our money goes first, we're now able to increase our annual savings from 10 cents to, let me see, 5. What was the math on that? I didn't even do it. 40, 45 to 45 cents of every dollar, 55 cents of every dollar instead of 10. We didn't do anything different. So let me show you how this works. Let's take a look under the hood. And the way I'm going to show you how to take a look at the under the hood of this actual policy and what this actually looks like of this machine, I'm going to do so by giving you an example. So let me ask this. How many of you would like to get back all the money for every car you'll ever buy, drive, and own in the future? You guys like that? Any car people on here? So let me show you how this works. So this is a look under the hood of one of these life insurance policies. So right here, this is what we would call an illustration, and it shows kind of the numbers of how the policy performs. So this would be the policy year. This would be the age of the individual. This would be the deposit amount going into the policy. This would be the recapture of the car loans. We'll come back to this stuff in just a second. This is what's called the cash value, the amount available to pull out of the policy. We'll talk more about that in a second. And then the death benefit. Again, we're not doing this for the death benefit. We're doing this for banking, but if there's a death benefit that's going to get paid out to your beneficiaries completely tax-free, are you okay with that being part of your new banking system also? Absolutely. That's how we start creating a legacy as well. But we'll come back to that part. Let me start with this. You can see these deposits right here. So a couple things. What are deposits? This is a whole life policy. Well, these deposits are actually premiums. So these are insurance premiums. So first off, why do we call them deposits? Well, simple mindset. Because if you have like your car insurance premium, your health insurance premium, you have all these premiums, typically you're going to think of a premium as a negative. You're going to think of it as a bill. You're going to think of it as something you have to do. Now let's look on the other hand. Let's say you're a real estate investor, you do a wholesale deal, you make $10,000. You do a flip, you make $45,000, or you get a nice bonus at work and you get $60,000. You get that check in your hand. Are you excited to go down to the local bank and deposit that check into your banking account, your checking account? Absolutely, right? So if we're excited to do that, why would I not be excited about depositing that same money into my banking system? So from this point forward, I'm going to challenge every single one of you to never refer to the money going into your new life insurance policy, your new banking system as a premium. It is now a deposit. The amount of money that you put into this thing is also completely up to you. You decide how much you want to deposit into this thing. You can deposit into it annually. You can deposit into it monthly. You can deposit into it quarterly. It's completely up to you. We'll build it and design it however you want to design it. You're in charge. So you can do 10,000 a year. You can do 100,000 a year. You can do 5,000 a year. It's completely up to you. The only recommendation I'll make to you is, as a guideline minimum, you do 10 times your age on a monthly basis. So if you're 40 years old, that's $400 a month or $4,800 a year. If you're 50 years old, that's $500 a month or $6,000 a year. Okay. If you're 30 years old, that's $300 a month or $3,600 a year. So that's what I would recommend. So that amount or more would be great for a first policy. And then ask me about dumping in a larger amount as well up front also. We can do that too. But just for simplicity purposes, those are what we now are going to call the deposits going into the policy each year. Now, the age of the individual. This person's 26. I'll show you some examples later of older people, younger people. Age does not matter. You can be 80 years old. You might not qualify to have a policy on your life, but you can still own a policy on somebody else's life. You can start a policy on your kids, on your spouse, on a business partner. So you can still own a policy, even if you're, I would say probably 75 or older would be tough to get qualified for a policy. Or if you just don't have great health, if unfortunately you had some kind of bad health issue or something like that, and you just don't qualify for life insurance, you can still own a policy. We just got to borrow somebody's life to own that policy on. So age and health doesn't really matter at the end of the day for these banking policies. And then the death benefit, like I mentioned, it's there. It's nice. It's going to create a legacy for your family for down the road, but that's not the reason we do this. We do this for banking purposes. That's it. All right. All right. So let's take a look at how this looks like for buying a car. All right. So this is that same policy, 10,000 a year going into it. So the third year of this policy, so you can see over here the cash value. The cash value in this money multiplier account is the amount that you have to borrow back out. So the first year when you put $10,000 in, you could borrow back out almost $6,000. If you want to have access to higher cash than this, great, we can do that now. So we can actually build, they came out with a new law last year that actually allows us to build stronger policies. So if you want to have higher cash value quicker, we can do that. Just let me know. This is an older policy right here, but no worries, because I want to show you how well this works, even with this design right here. So the 10,000 goes in. So the third year of this thing, they decide that they want to buy a $25,000 car. So they pull the money out of the cash value, purchase the car. Now they own it. Now let me ask this question. If you were to go get a loan from a traditional bank or Ally Financial or BMW or Honda or whatever, would you pay that bank back? Yes, right? You have to, or they're going to repo your car. So if you come and you borrow money from your bank, take money from your bank to buy a car, is it okay if you pay your bank back as well? Yes, right? You're going to be your own banker. Now you can set your terms. You can decide what that looks like. If you skip some payments, maybe you don't repossess your own car, you're in control, but you're going to want to pay yourself back. You're going to want to be an honest banker. So that's exactly what we do. We pay ourselves back $500 a month for the next 5 years. and recapture that money back into our bank account. So what have we done so far? In 7 years, we put 70,000 in. We took $25,000 out. We recaptured 30,000 of that money back in. So we put a total of $75,000 in. We have a vehicle sitting in our driveway worth $25,000, free and clear, paid for. And we have $67,000 sitting in our bank account ready to go. So if I put 75 in, I have 67 available, which is 91 cents. I have a $25,000 car. I just recaptured 91% of every dollar I spent to purchase that vehicle. Not bad. How much money are you recapturing from vehicles you're buying? Probably none, right? But I told you before, I was going to show you how to get back all of your money for every car you'll ever buy, drive, and own. Not 91%. So here's the thing. Does this policy, does this banking system stop after 7 years? No, it's for life. It's a permanent policy. It's for your life. It's going to grow and compound for literally the rest of your life. So this thing keeps going. And to show you this example, you would want to continue to put money into this thing. And I'll show you why in just a second, because every year the growth on it becomes stronger and stronger and stronger. But for this example right here, let's just pretend we put no more money into this thing, because I want to show you how it's going to compound and grow even on its own without adding any extra money. And this thing is never going to stop for the rest of your life until you pass. So check this out. In the 8th year, we buy another car. We still got our first car sitting there. Now we buy a second car. So we take the money out of the policy. We do the same thing. We're an honest banker. We pay ourselves back over the next 5 years. So let's recap this. Through 12 years, we put through years 8 through 12, we put no new money into it. We bought a $25,000 car. We recaptured all that money back into the policy for a net injection of $25,000. We took 25,000 out, or 30,000. We took 25 out, so a net injection of $5,000. But look what happens. Our policy grew from $67,000 to $91,000. We only put $5,000 into it. It continued to compound and grow, even though we put no new money into it. Even though we took money out of it and used it to purchase a car. And it's just going to keep compounding and compounding and compounding forever. So what do we have now? We have a bank account, our policy, with $91,000 in it. We put $80,000 into it ourselves, 75 plus 5. And we purchased 2 vehicles worth $50,000 now that are sitting in our driveway, free and clear, paid for. I'd say we've recaptured all of our money for both of those vehicles and some. Would you agree with me on that? And all we did was change where our money went first. So to do this, we got to follow 3 rules to make this work right here. Rule number 1, pay yourself first. Rule number 2, pay yourself with interest. Rule number 3, always recycle and recapture your money. So pull it out, pay yourself first, recapture it back in so you can use it over and over and over again. So one more time, pay yourself first, pay yourself with interest, always recycle and recapture your money. And if this works for a car, what else? How about an airplane? How about a boat? How about college? You real estate investors on here. How about a roof? How about a kitchen? How about homeowners on here? How about solar panels? How about a new bathroom? How about a pool? Now let's pivot for just a second and talk a little bit about debts, because this is really cool. This is how you're going to be able to pay off your debts much quicker while still building wealth. And this is really cool right here. So check this out. So this is a real case study. This is a chiropractor. And yeah, property taxes, Dexter, absolutely. So this is a case study of a chiropractor. This was one of Brent's clients about 10 years ago. And something that I found is it seems like the more money you make, the more money you spend. And sometimes when that occurs, people find themselves in a little bit of debt. And this chiropractor found himself in $478,000 of third-party debt. And so what we did is we did the math for him. He was paying about $69,000 a year, $5,700 a month in third-party debt. And we did the math. It would have taken him about 19 years to pay all this off if he would have continued to do what he was doing. So we said, all right, let me show you how you can use your own bank and pay down debt a lot quicker while continuing to build wealth. So check this out. So what we did is we started a policy for him. he wanted to put $25,000 a year into it. So he puts $25,000 a year into this new policy in year one. In year one, he has a little under $15,000 to pull back out to use immediately. Within 30 days, he can pull that back out. Now, again, I said it before, we can build policies with higher cash value now, but I want to use this as an example just to show you how powerful it still is. All right. So we put the 25 in, immediately pull the 15,000 out, and then we use it to pay off the Discover card, pay off the Lowe's card, pay down the Nordstrom balance. So what did we just do there? We eliminated a couple payments, $448 a month worth. So 287 and 161 equals 448 a month. Now, we just paid off Discover and Lowe's and no longer have those payments. What are we going to do with that 448 a month that we were giving them prior? Well, that 448 a month that we were giving to Discover and Lowe's before, what we're going to do now is we're going to give that 448 a month instead of those banks, we're going to give it to our bank. So we're going to start recapturing our money through the interest that we were giving to other people prior. So what we have now is we have $5,329 a month going to third-party debtors, and we have $448 a month going back to our banking system. Year two, $25,000 goes in. Now we have $16,000 available in the policy, and you'll see this number get bigger and bigger every single year. We also have $5,300 in recaptured payments. Again, that was the $448 a month that we started recapturing back to ourselves. It builds up in what we call a segregated bank account, which is just a separate bank account that allows it. We use that as like a holding tank for money that comes from the policy. Then it goes to where it needs to be used. Then we recapture it back in. And then from there, we either put it back into the policy or we put it back to the next use. Well, in this case, we still had more debt. So we're going to use that money that was recaptured in that segregated account to tackle more debt. So if I take the cash value and the recaptured payments, I have a total of $22,000 now that I can use. So what am I going to do? Pay off the Nordstrom, pay off the Wells Fargo, pay off the private loan, pay down the BMW. Okay, same thing. Now I have $3,800 a month going to third-party debtors, $1,900 a month now going back to my personal bank. Year three, same thing, 25. Bye-bye BMW, bye-bye West Marine, lowers condo, $1,900 a month coming back to me, is now $3,600 a month coming back to me, and only $2,100 a month going to third-party debtors. So let me make sure you're following so far. Like I said, it's a marathon. It's going to take a few years to do this, but check this out. How much did we put in so far? 75. How much have we taken out so far? 55. So how much remains inside the policy? 20,000? That's what you would think, right? That's what the math would be. If I put 75 in and took 55 out, I got 20 left. But that's not how your bank works. Because just like traditional banks, when we put our money in our bank, that money's going to compound and grow for the rest of our life, guaranteed, through interest. It's going to grow through the company dividends, even when we're pulling the money out and using it. So the real answer to this is $75,000. The money goes in, and the way that this works is when you take the money out of the policy, it comes out via a loan. The insurance company is going to use your policy, the cash value, as collateral for that loan. You're basically borrowing against your death benefit. So the insurance company is going to use your money as collateral, but that allows your money to remain in there compounding and growing for you. Then you take the loan out and you use that money however you want to use it. Plain and simple. So that's what allows us to keep that money in there compounding and growing for us. So what's year four look like? 25 in, 26 available, 44,000 in recaptured payments, $70,000 available. Year five of the policy, same thing. All right, now we eliminated that. Now we got 4,500 coming back to us and only 1,221 going to the house. Now in year six of this thing, watch what happens. So up here in the corner, we have $25,000 that goes into his first policy, or $10,000. This is the first policy right here. $10,000 that goes into the first policy. Remember though, we were putting $25,000 a year in before. You see, at some point in the future, the amount that you're putting into the policy is going to drop. In this case, it dropped from 25 to 10,000. There's nothing we can do about that. The IRS regulates these things. There's stuff called the MEC rules that when we design these and build these, we have to work within those MEC rules. And so one of those things sometimes that happens is we have to lower after a certain amount of years. Typically now it happens in the 11th year, not the 6th year. But in this case, it happened in the 6th year. So and we'll know all this up front, guys. We'll design it for you. This was designed specifically this way for a reason. But nonetheless, in the 6th year, they could only put 10,000 in. So they put 10,000 in the first policy. They immediately have 13,000 in growth that they could pull back out. Not a bad little 30% cash on cash return in the 6th year right there. And then what is this other 25,000 over here? Well, this is policy number 2. So what happens is whenever you max out your first policy where you can't put more money in it than it will hold, it'll only hold 10,000 a year in this example. Whenever you want to put more money in to grow your banking system, you just open up more policies. So you can open up additional policies next week, next month, next year, in year 6, whenever you're ready. Whenever you have more money sitting around that you want to put in, then that policy will hold. Boom, start up a second policy. So that's what the chiropractor did. So now he's got 35,000 a year going in. He's got cash value available in 2 policies to use. He's got all the recaptured payments. Now we got $82,000 available in the 6th year of this thing. What are we going to do? We're going to pay off the house. We've now eliminated in 6 years all third-party debt that would have otherwise taken 19 years. Now we have $5,777 a month that we're going to continue to pay back into our banking system. All of that interest that was going to all those other third-party debtors is now staying within my family's financial futures, period. And we're going to continue to recapture that money until it replenishes our account. And then we can start using it for some fun stuff. And what do I mean by that? I mean by growing wealth, by investing. And I'll show you that in just a second. But what I just showed you just now is what we call a debt map. So every single one of you that starts a policy with us, we have what's called our mapping team. And as soon as your policy is started, so you go through the approval process, you fund the policy and you start it. You put the money into it. You make your first deposit. You go right over to what's called our mapping team. And our mapping team is going to help you start using it. So immediately within 30 days, pull your first loan out. If you have debt, we're going to do what's called a cash flow analysis with you. And we're going to analyze your debt. And we're going to create what we call a debt map. And it's going to be exactly what you just saw that we did for the chiropractor. We'll do that for you. Or if you want to use the money to buy a car, we'll create the plan for you, the money movement. Or if you're using it for investing or business, we'll show you exactly how to do that. So that's what's called our mapping team. And by the way, there's no charge for any of this stuff. You see, guys, when we do a policy, when we start a policy for you, I'm a licensed insurance agent to do this. The Money Multiplier is a licensed brokerage. So we do not charge you a dime ever. You never pay me any money for any of this stuff. All we do is we make a commission off of bringing the policies, bringing the business to the insurance companies. We make a small commission off each policy that we do. Now, it is a reduced commission. We make 60 to 90% less than what a typical whole life policy would typically pay out. But that's how we do this, to give you access to all that money right away. So you could take loans from the cash value immediately within 30 days. So you could start using this thing, not in 3 years, not in 5 years, not in 10 years from now, not when you pass, but right now to create your banking system. We give up a lot of commission to do this, but we do a lot of business. And because we don't charge anything, because we help you, people open multiple policies. You know, if this resonates with you, I will ask you to go share this with your friends, with your family, invite them next Tuesday to Tuesday night's webinar. I'll do the exact same thing. Send them the recording to this, let them watch it, and then let me help them start as well. And that's how we do business, guys. Plain and simple. It's real easy. It's what I call a financial GPS. So those of you that want to schedule a call with me and talk about if this is right for you or not, one of the things on the first call, we're going to talk about a little bit about what I call a financial GPS. So I'm going to talk to you about where are you now? Where do you want to be in the short term, in the midterm, in the long term? What are your goals? What do you got going on now? And let's get you there the quickest way possible. So I'll set you up with a financial GPS. I'll help you get this started, and we'll help you start achieving and meeting those goals. That's what it's all about right there. So here's the last question. What if you don't have any bad debt? What if you don't need a new car? Should you still do this? Should you still become your own bank? And I say, heck yeah. This is where the fun begins. You know, let's start building wealth. Let's create a legacy for ourselves. So let me show you how that's done. We do that through building wealth multiple ways. So our money goes into our policies, into our banking system. We then take that money, we immediately pull it out, and we put that money to work. What I do, what I would recommend you mimic, we do what the banks do again. We do what successful, wealthy people do. That's it. And this is what we teach in Money School. This is why we partner with various other educational companies and groups that teach this stuff specifically. See, we focus on money, things like private money lending, private money raising, passive real estate investing, notes, business, becoming your own bank. But then we have partners that actually coach you and train you on active real estate investing, how to buy crypto, how to buy notes, how to start a business, how to protect your money through LLCs and corporations and different trusts and charities and things like that. So we have it all for you through Money School. And this is ways that we create wealth. We take our money and we immediately get that money moving. See, there's something that I've learned over the years. There's 2 laws for creating growing wealth. Number 1, compounding interest. Albert Einstein said this best: the 8th wonder of the world. Those who understand it, use it. Those who don't, pay it. Uninterrupted compounding interest for the rest of your life. How's that sound? That's what this policy does. And then number 2, money movement and flow. Money sitting still is losing money. Money in motion is making more money. And that's what these policies, this is what becoming your own bank allows us to do, is we can put our money into a vehicle where we get uninterrupted, guaranteed, tax-free compounding growth for the rest of our lives, while simultaneously pulling all that money out and getting that money moving and making more money for us through passive investing, through real estate, through all these various means of creating, building wealth. That's it. That's the magic formula right there. So just a couple examples for you. This is what we would call a high cash value policy. But how much do you want to fund your new bank with? So start thinking about that. I mentioned before, you could put a larger amount in up front. Look at this one. They had $100,000 or $150,000 sitting there in a bank account earning nothing. Dump it in the policy. Now that 150, and look over here. Look at the cash value. See on the right side, $132,000 available. They put 150 in, immediately put 132 back out. Get that money moving, making more money. But that 150,000 is now in there compounding for the rest of their lives. This was a 41-year-old female, by the way. This was a policy just a few months ago I did for a real estate investor. The 150,000 though that they had this year right now, they did not feel comfortable. She did not feel comfortable doing 150 every year. So she only wanted to do 50,000 a year. So she dumped in the 150 the first year, then 50,000 a year after that. And then look at the 11th year of this thing, drops down to 17,500. But look what happens. In the 12th year of this policy, she deposits $17,500 into it. Look at the growth. You see that over there? $47,000. Imagine if you had an ATM where you could deposit $17,000 and immediately the next day pull back out $47,000. How many of you would want to do that time and time again? Absolutely. And all we're doing is changing where our money goes first. That's the power of becoming your own bank. And look at that. Every year, 49,000 the year after, 51,000 the year after, 54,000 the year after. It's the same $17,000 deposit going in. Look at the growth. Stronger and stronger. Look at that death benefit. Stronger and stronger every single year. Here's another policy. 50,000 going in up front, $500 a month. So you got some money sitting there, dump it in there, then do something manageable. $500 a month. Who can't do that? And look at this thing. 21% growth in the second year, 54% growth in the 10th year. Access to capital, 381% of what they put in. 25th year of this thing in retirement. Crazy. Here's a flow of a private money loan, just to give you an example. So let's say I put $23,000 into my new policy, or let's say I put 100,000 in, but let's say I need $23,000 to pull out to do a private money deal. So I run a community called the Private Money Club. You go to privatemoneyclub.com and check this out. But the Private Money Club is a community of borrowers and lenders and borrowers. So if I don't actively want to go do real estate investing, but I want to take advantage of the real estate market right now, which I do, I can lend my money to an active investor and they're going to passively pay me interest on my money. Most common right now I'm getting is 12% of my money from these private money deals. So I take my money out of the policy into the segregated account. Now, when I borrow money from my policy, I'm going to pay the insurance company 4 to 5% interest annually. It's annual simple interest. So if I only have that money out for 6 months, it's going to be 2 to 2.5%. If I only have it out for 3 months, it's 1 to 1.25%. If I have it out all year, it's 4 to 5%, depending on the company. So it's 4 to 5% simple interest to borrow the money out to use. So I take the 23,000 out, it goes into my segregated account. I told you about that. From there, I wire the money to the escrow company or attorney for the private money club deal. That borrower gets the money to do the deal. And now they start paying me monthly interest only payments. It comes back to my segregated account. I'm keeping the spread. So I'm keeping the spread on the 5% and the 12% that I'm making, 7%, all the time my money's sitting in there, compounding and growing uninterrupted for me. I'm recapturing the money, getting back into there that I don't keep as profit. And I'm going to do this over and over and over again. So just a quick little example of what that flow of money looks like. And this is just a quick look at what the Private Money Club looks like. It's privatemoneyclub.com. It's a membership-based site. If you have any questions on that, I'm happy to answer the questions on that as well. All right, so this is just one more example of using this for private money lending. So here we go. So this is the 8th year of the policy. I put $48,000 into the policy in the 8th year of this thing. My bank grows by $66,000 that year. That is a 37% return on my money that year. I put 48,000 in, it grows by 37%. I take that money out. I have 531 available over here. Let's say I take $100,000 out to do a private money loan. I lend my money out at 12%. My bank grew by 37%. I paid 5% to the interest to the insurance company to take that money out to use it. So if I did my math correctly, I just earned a 44% return on my money that year. We did nothing different. Think about it. What would you rather make, 12% or 44%? Because the choice is yours. Your money has to go somewhere. Think about it. We didn't do anything different except where our money goes first. See that $150,000, that $50,000 a year that she's saving, that money has to go somewhere. Someone else's bank, under a mattress, or into your bank. You choose. So she chooses through into her bank. By doing so, and then taking that money and lending it out or doing some kind of real estate deal, she's not making only 12%. Because what is your savings account or your business banking account paying you when you take the money out? Nothing. What are they paying you when the money's in there? Nothing. Kind of a trick question, but seriously, nothing, right? Your bank is compounding and growing whether you're using the money or not. So why not take it out and keep the money moving to make more money? So by doing that, we just created a 44% return instead of 12% return on our money. Is everybody okay with that? That's the power of becoming your own banker. So when it comes to these policies, a couple things in case I missed it. The loans never have to be repaid. You set the terms. The loans come out tax-free. You set the terms. You never repay them. Nobody cares. The insurance company is just going to take that outstanding loan amount out of the death benefit before they pay the death benefit to your beneficiaries. The death benefit is tax-free, creates a legacy for you and your loved ones. The internal values of this thing grow tax-free. The policies are exempt from judgments and liens in most states, protected, private. There's lots of uses for these things when it comes to business. So you can loan the money to your business. You can have a company-owned life insurance policy. So if you own a business, remember to ask me about that on our phone call, and we can talk about the best way to structure it and use the policy, whether it's for you or for your business. We could start policies for kids. I just started one last year for my 5-year-old. It's incredible how this thing grows over time. Because think about it, these policies work off compounding interest. Compounding interest works off time. So you should see what this thing looks like when my son turns 16 years old and we buy a car for him. When he turns 18, 19 years old and he goes to college. When he wants to start his own business. And not only is he going to have this bank to help him get started financially in life, what else am I going to do with him leading up to that point? I'm going to teach him. I'm going to teach him financial education. Financial education is not taught in elementary school, in high school, in college, anywhere. You have to seek it out. So me as a parent, I feel like one of my jobs is to teach my kid, to teach his friends, to teach whoever wants to listen. So kids policies are a beautiful thing as well. Remember to ask me about those if you're interested in that. And again, you decide up here, you decide how much you want to fund this thing with, load it up front, whatever that looks like. And we could talk about those options on the call as well. So these are no longer excuses. We're simply going to do what the wealthy do what the banks do. Time to create success. Warren Buffett says it best. If poor people would just do what rich people do, they wouldn't be poor anymore. Okay, Warren, make it sound easy. Warren Buffett also says, buy low, sell high, and don't lose money. Thanks, Warren. Sounds easy. He does have a way of simplifying things, but he's right, 100%. So ask yourself these last 2 questions. Are you better off with or without this thing while you're alive right now? Are you better off with or without this thing when you pass. If the answer to this is yes on either one of these questions or both, I would love to talk with you. So here's what you're going to want to do is you're going to want to go to this site right here. As soon as you put in your information, my call calendar will pop up and you will be able to schedule a call with me. I will warn you, my schedule is backed out a little bit right now. So if you want to talk sooner, just text me, okay? I put my my cell phone on the screen. Just text me, and what we'll do is we will schedule a call sooner. But if you want to talk in a couple weeks, great. Get the ebooks, start reading them, listen to some audiobooks, continue to learn, study, hop on our webinars until we hop on the phone and we talk, and then we'll get you set up, we'll get you started. Again, no pressure. If it makes sense, great. If not, no worries. It's a free call, no questions, no problem. I'm here to help you guys, bottom line. That's it. I will never, ever, I can promise you, I will never, ever chase after any of you to get this started. Just the opposite. You're going to have to come to me, guys. So that's it. That's all I got for you right now. So with that being said, you can get the copies of those books as well on that link right there. Schedule a call with me. So for everybody that's here right now, if you have any questions, throw them in the box. Throw them in the Q&A or the chat box. I'll answer those real fast, and then we will wrap things up. And then also, you guys follow me on social media, all my social media, Facebook, Instagram. I'm putting up a lot of cool stuff right now. So at The Real Snaggy, you can follow me on there. I'm more active on Facebook right now for some reason, but I'm trying to get involved more on like Instagram and some of that stuff. I'm just a little old school, but my link tree that I put in the chat box right there, if you want to share that, at the top of that, it has the recorded version of one of these presentations. It has the YouTube links, so you can watch. This will be put on the YouTube link tomorrow, so you can watch the recording of this one if you want. It's got some other resources. It's got all of our webinars. It's got my call calendar on there. So feel free to share that with anybody you would want to. Ranjit, as long as you have an insurable interest in the US, we can typically do it. So if you need a US bank account, you might need like a US address, and you have to be in the US for the medical exam. But a lot of times we can get it done with just that. So Ranjit, just let me know what you're thinking and we can definitely talk about that. Okay. Marla said she's been a member for a couple of years, finally got it, looked at my account. Yeah. If you're part of Marla, if you're part of Money Multiplier, get with the mapping team, and your mapping agent will help you out, or shoot me an email and I can try and help you out. Marla, I'll connect you with whoever, had helped you originally, and they can get you going. And then if you ever want to look at additional policies or start for kids or a spouse or a friend or no other people, send them to me, please. And I'll help them out. And then anything I can do for you, Marla, too, let me know. But your mapping agent will be the one that has access to your policy and can do all that for you that I just showed you. No problem. So William said, speaking of Jim Harbaugh, how do I get my employer to put money into my banking policy? Yeah, we can do that, William. They would just have to be on board for doing so. So let's set up a call with your employer. I don't know, whoever it is. I do company-owned policies all the time, and we can definitely maybe do something for you. So let me know, William. And yeah, Tess, absolutely. Marla, welcome. All right, guys. Well, thank you for being here tonight. I don't see any other questions coming in. That's all I got right now. I'm going to go enjoy the rest of the evening with my son before he goes to bed. And we'll see you guys tomorrow on the Wealth webinar. And hope you have a great evening. We'll see you soon. Thank you. Bye.